Hello, welcome to the 27th lecture of the course Forex in 3 Steps. Since we're almost done with the classical technical analysis part of the course, let's finish it by first getting to know professional terms in classical analysis. Let's first talk about some trading styles. What are trading styles? Each one of you, just like we explained earlier in the first few lectures of the course, should follow whatever he desires in terms of trading style. We talked about different investment styles and trading personalities, but when it comes to technical analysis, there are mainly 3 styles of trading. The first one is called scalping. What is scalping? Scalping is basically using the very low time frames and entering and exiting trades within minutes or maximum hours. So when scalping traders usually use the 1 minute, the 5 minute, the 15 minute, and they usually do not enter trades on anything higher than these time frames. These are the time frames they usually stick with when scalping because they require quick entries and quick exits, and they do not remain long in their trades. This, of course, is a style that suits people who are kind of impatient. They want quick profits and quick entries and exits, and also it requires time. It requires you to be on the charts for quite some time. So if someone has a 9 to 5 and cannot spend much time on the charts, then probably scalping is not for you. The other style is an intraday trader. The intraday trader mainly enters on the 30-minute time frame, 1 hour or 4-hour time frame. This style is the middle ground. It is for people who trade daily but do not like scalping. They think that scalping is too quick for them, or they do not have enough time to scalp, so they decide to trade daily and monitor the markets on a daily basis rather than on a minute or hour basis. Intraday traders are neither impatient or patient. They are in the middle, and they do not like too much risk, and they also do not like too much safe play. And the last style are the swing traders. Swing traders can stay in a trade for over a week and even over a month, and as you can see here, their main time frames are usually the daily time frame, the weekly time frame, and the monthly time frame. And imagine entering on a monthly time frame means that each candle is formed within 30 days. Imagine a candle playing out for 30 days. Of course, that means that they can stay in their trades for months and even years. Some people swing trade and take trades and stay in trades for quite some time. These people are usually people who like being safe, who like risking a low amount, and people who are patient and have no problems waiting for their profits to hit in the long term. The second thing I wanted to talk about is breaks and breakouts. So we kind of explained breaks and breakouts in the previous lectures, but again, because this is very important, breaks and breakouts tell us a lot about the charts and about where price action may go to. Breaks to the upside indicate bullish momentum and indicate that price may continue to the upside, and vice versa. Bearish breaks usually means that price may break to the downside. Usually after any break, whether it is a break of a chart pattern, whether it's a break of structure when we take the SMC lectures in the following lectures, it doesn't matter what break it is. Usually after any kind of break, price and traders expect a pullback or a retracement. What is a pullback or retracement? We will talk about it, but in short, it is basically the meaning that after any break, price usually returns to the place where it broke from in order to retest the area it broke from, and people and large orders and financial institutions and the whales of the markets start filling their positions, and before price rockets off. And the third thing I wanted to talk about is what I just explained, retracements and pullbacks. It basically is a retest that appears after breaking whatever a trend line, support or resistance, the broken areas are retested about 80% of the time. So statistically speaking, usually price likes and always likes to return to the area that just broke for a retest. But that doesn't mean that it always does that. So you can never rely 100% on waiting for the retracement. Sometimes you need to be aggressive and you need to enter on the breaks themselves. Otherwise, price may leave and move in your way without you being in the trade. There are some conditions of a retest. Firstly, breaking the zone correctly with a strong candle is needed to be able and to assure you that a retest will happen. Secondly, price must retest with short-term candles. It is much preferred for price to retrace with small candles and not large ones to assure you that this is only a retest. Because if price starts retracing, so for example here, if price after it broke this supply and supply flipped to, or resistance flipped to support, and price broke and then it retraced and all the candles are looking this way, this means that there is bearish momentum and this area might not hold. So it is preferred that the retest, when it happens, the candles are usually required to be small candles and not big ones. Thirdly, after the retest, a strong impulsive candle should form, and you can see it in this example here. After the retest and after we mitigated and hit this support zone, price made a doji candle and then a very bullish candle, which we called them and covered it and called them the bullish hammer. So it is best to see this candlestick form, this pattern of the candlestick form when buying, and of course vice versa when selling. But this can act like a confirmation that the retracement is finished and price will start reversing once again after the pullback is complete. Fourth thing you should know is that a retest fails if the price forms a long-term candle. And that means if price starts digging into your support zone with bearish candles and you cannot see any follow through and any type of bullish momentum or strength, then the likelihood of the zone failing and the retest is a reversal is likely to happen. Here's a quick strategy you can use, which is very brief, very easy, and you can go back test it yourself with only classical analysis. We will still cover much more in-depth advanced technical analysis later on in the course, but this is a very simple and brief strategy you can use straight away, but make sure you back test it, make sure you're comfortable with it in order to succeed in the financial markets. So the method is basically you identifying the general trend using the 200 moving average, just like we covered. If the 200 moving average is pointing to the upside and it is moving to the upside, that means that the overall trend is bullish. If the moving average starts reversing and pointing downward, that means that the trend is bearish. The second step of the strategy is draw support and resistance on higher time frames. These support and resistance zones will allow you to make sure you know where to look for trades and where to look for buys and when to look for sells. After that, draw trend lines on different time frames in order to identify the short-term trends as well. So now you will identify the overall trend with the 200 moving average and the short-term trend by drawing a trend line. Then you can define the entry method. We have covered many entry methods. You can wait for the trend line to break, you can wait for the moving average to break, you can use divergences, chart patterns, candlestick patterns, all of these you can use them to define your entry method. This is up to you. You need to back test, you need to go back in time and check which one you prefer, which strategy you prefer, which entry method you prefer, because your entry is very important in the financial markets. No matter what your entry method is, you will need to look for a breakout and wait for a retest. Sometimes you may have to enter on a breakout, especially if price action is volatile and there is lots of volume in a specific financial market. then you may need to enter on the break, which will cause your stop loss to be a bit wide, which can hinder your risk to reward. But that doesn't mean that a win is a win. A win is a win at the end of the day, so it doesn't matter. But usually wait for a retest and a confirmation before entering any trade. The sixth step is rebound with price action and indicators, which basically means that on the retest, on the rebound, or on the retracement, whatever you want to call it, you can call it a pullback, a retracement, a retest, or a rebound, whatever, they all mean the same. But when the rebound happens, it is best to watch price action and see how it develops in order to enter. Before you enter, you should look at the price action and on the indicators as well before entering any trade, in order to confirm your trade. Even after the breakout and even after the retest, you need a confirmation during the retest in order to enter. And the last thing you have to do, of course, in any strategy, not only this one, is set your take profit and of course the stop loss. This is very important, and please never enter any trade without setting a tight stop loss. That is it for this lecture. See you in the next one.